In today's globalized business environment, cross-border operations have become a vital component of many companies' growth strategies. Businesses are increasingly expanding into international markets to access new customer segments, tap into valuable resources, and secure cost-efficient production bases. However, alongside these vast opportunities, cross-border activities bring a complex array of financial risks that can severely affect a company's financial health. Understanding these risks is crucial for making well-informed decisions and developing effective risk management strategies. Exchange rate volatility. A persistent challenge, exchange rate fluctuations rank among the most prominent financial risks in cross-border operations. When a company engages in transactions across multiple currencies, shifts in exchange rates can have far-reaching implications for its revenues, costs, and profit margins. Take, for example, a US-based firm that exports goods to Europe. If the euro depreciates against the US dollar, the company will receive fewer dollars when converting its euro-denominated revenues. This can lead to a substantial decline in its profit margins. Conversely, for companies importing raw materials from abroad, a strengthening of the local currency can drive up the cost of imports. Exchange rate swings also affect the value of a company's foreign-denominated assets and liabilities. For instance, if a company is borrowed in a foreign currency and that currency appreciates, the company's debt burden in its domestic currency will increase significantly. To mitigate the impact of exchange rate fluctuations, companies can deploy various hedging techniques. Currency forward contracts enable companies to lock in an exchange rate for a future transaction, ensuring predictability in cash flows. Options contracts provide the right, but not the obligation, to buy or sell a currency at a preset rate, offering flexibility in managing exchange rate risk. Another approach is natural hedging, where a company aligns its foreign currency revenues with its foreign currency costs, thereby reducing its overall exposure to exchange rate movements. Interest rate divergences. Interest rate differentials between countries pose significant risks in cross-border operations. When a company borrows in a foreign country, it is subject to the interest rate conditions of that nation. If interest rates in the borrowing country increase, the company's interest expenses will rise, putting pressure on its profitability. Furthermore, interest rate disparities can influence the cost of capital for a company's international operations. For example, a company may find it more expensive to finance its expansion in a high-interest rate country compared to its home country. This can affect the company's investment choices and its competitiveness in the global market. Companies can manage interest rate risk through the use of interest rate swaps, which allow them to exchange fixed rate for floating rate interest payments, or vice versa. By closely analyzing interest rate trends and economic forecasts, companies can also time their borrowing and investment decisions to minimize the impact of interest rate differences. Credit risk in international transactions. Credit risk is another major concern in cross-border operations. When a company sells goods or services to overseas customers, there is a risk of payment default. This risk is compounded by factors such as differences in legal systems, cultural norms, and economic stability across countries. For example, a company may have fewer legal remedies in the event of a foreign customer's default compared to a domestic one. Additionally, economic downturns in a foreign country can heighten the probability of customer defaults. To manage credit risk, companies can conduct comprehensive credit checks on their foreign customers before entering into business deals. They may also consider purchasing trade credit insurance, which protects against losses resulting from customer defaults. Regulatory and tax risks. Cross-border operations are subject to a complex network of regulations and tax laws in different countries. Changes in regulations can have a direct bearing on a company's financial performance. For example, new tax laws may increase the company's tax liability, while alterations in trade policies can impact its supply chain and pricing strategies. Moreover, regulatory compliance can be costly, particularly for small and medium-sized enterprises. To manage regulatory and tax risks, companies must stay updated on the legal and regulatory environment in the countries where they operate. They should also collaborate with local legal and tax advisors to ensure compliance and optimize their tax strategies. Liquidity risk in cross-border operations. Liquidity risk refers to the risk that a company may lack sufficient funds to meet its short-term obligations in a foreign country. This can be caused by factors such as restrictions on capital flows, currency convertibility issues, or disruptions in the international financial markets. For example, during a financial crisis, a company may struggle to obtain the necessary funds to pay its suppliers or employees in a foreign country. To manage liquidity risk, companies should maintain a diversified funding portfolio and have contingency plans in place. They can also build relationships with local banks and financial institutions to ensure access to emergency funding when required. In conclusion, cross-border operations present significant growth opportunities, but they also entail a wide spectrum of financial risks. By understanding these risks and implementing appropriate risk management strategies, companies can navigate the challenges of international business and position themselves for long-term success in the global marketplace.